I think safe withdrawal rates are hugely important because it deals with what everyone is thinking about.
There are immediate needs for this that myself and I'm sure most people have clients from a variety of stages, either already retired, just about to be, or quite a ways from it. And for those that are just about to retire, I think this will enhance the conversations we can have with them.
So the idea of safe withdrawal rates has been around for about 20 years now. The basic idea of, so if I've got this portfolio that's got some volatility to it, I'm trying to figure out how much can I sustainably withdraw from an ongoing basis. I need to take some number that's conservative enough that if something bad happens to the markets, I'll have enough still in when we recover. And obviously if markets go up, then things will be fine. And so the idea of that safe withdrawal rate research has always been, where is the balancing point between we want to take as much as we can, but we want to spend conservatively enough that we can manage through a bad sequence early in retirement and still be able to recover thereafter. So we've seen a big increase in utilization of safe withdrawal rates over the past couple of years as we move towards this increasingly sort of portfolio-centric world. I think the whole rise of defined contribution plans and the decline of defined benefit plans has shifted us into this world where increasingly you retire and you have this pot of money and you have to figure out how much is safe to spend that we're not going to ruin our retirement and our lifestyle if we hit some speed bumps along the way. So we've seen this ongoing rise in interest for safe withdrawal rates, but at the same time, we need to balance out that the original research was kind of a fairly generic rule for one particular situation, a retiree with completely flat spending for a 30-year time horizon. And we're now finding, well, how can we adapt that a little bit more to people's individual circumstances while still keeping the essence of spend conservatively enough to manage the difficult markets, but still be able to enjoy your money during your lifetime. So I think there are a few challenges that crop up as we're trying to set a safe withdrawal rate for people. On the one end is simply how are we going to invest that money? So all of the ongoing challenges that we have around effective investment, proper diversification, how to improve a balance of return and risk continues to be ever present in safe withdrawal rates. The other piece that we have to tie to it at the same time, though, is so if we're going to set this spending path, and we're going to tell someone, here's the spending floor that you can start with. If things go better, obviously we'll raise it, but we want to at least lock you in with a comfortable base. We really have to focus on, where do you set that line? Where do you set that floor? What is a safe starting point that you can then adjust from over time, but what can we do to really get that number right out of the gate? So certainly the challenge, I think, anytime we're trying to set spending patterns, dealing with an uncertain future is sort of how do we deal with, frankly, whatever the latest challenges are. So whether it's market problems or financial crisis or low interest rates or rising interest rates or Fed action or Fed inaction or whatever it is over from century to century. Frankly, the idea of the safe withdrawal rate research and approach out of the gate is, let's set a number that's low enough so that if today is the first day of the next global economic catastrophe, your spending will be okay. And that's actually the origin of the research. What would have worked if you retired the day before the crash of 1929? What would have happened if you retired right before the rising interest rates and market decline of the 1970s? So what spending level can we set that if you are retiring on the eve of a catastrophe, things will be okay? Such that by definition, if you get anything better than that, you're going to have the nice choices of leave a very nice inheritance for your children, or more realistically, sit down and review your retirement a little ways in, find out that things are going better than you had first feared, and that it's time to lift your spending up. I think the part of the reason, again, why we're seeing this rise of interest around safe withdrawal rates, on the one end, we've had the shift away from the defined benefit plans and over to the defined contribution plans, and the other really is the introduction of the baby boomer, the fact that not only do we have more defined contribution plans, but we now have 10,000 baby boomers a day trying to figure out how to retire with those defined contribution plans and the large account balances. I don't know that baby boomers necessarily do anything materially different around this safe withdrawal rate idea, which is really just how do we set an appropriate spending floor for a volatile portfolio and then adjust along the way. But certainly I think the awareness and interest around this research has continued to grow and will continue from here as more and more boomers transition into retirement and have to deal very centrally with this problem. So I guess if there are two key takeaways to think about in the context of safe withdrawal rates. First is, while we frame this as a flooring strategy, so here's a safe spending level to start, and then we'll adjust over time, we'll adjust upwards if things are better, and we'll at least know that our floor is safe if things are bad. It is still something we need to monitor on an ongoing basis. So it's not as though safe withdrawal rates are an autopilot program. You come to see once when you retire at age 65, here's your spending level, let me know when you die and your kids are ready to help out with the inheritance. Like it often gets explained that way or framed that way sometimes in the academic literature, but it's not a pure autopilot program. The second thing to be cognizant of in the context of safe withdrawal rates is that while we've often thrown around that 4 to 4.5% number as this base safe withdrawal rate, that was still for a very specific set of research with a 2-asset class portfolio with a specific 30-year time horizon, with spending that is never adjusted in retirement aside from regular inflation adjustments. And of course, the reality in today's world, we have a lot of different time horizons we deal with. People have varying levels of risk tolerance. People have varying time horizons that we're working with. People have varying portfolios with a lot of different diversification that goes beyond just a 2-asset class portfolio. So we have a lot more that we manage to now. And what that means at the end of the day is that safe withdrawal rate has to get customized and adapted a little bit more. And I think that's one of the focal points we'll see more going forward is how do we expand this safe withdrawal rate framework a bit beyond just saying, hey, 4%, here you go, have a nice day, to, all right, well, given your individual circumstances, goals, needs, risk tolerance, desires, and the rest, here's what your individualized, customized safe withdrawal rate would look like.
Gives you a new perspective versus either the programs that we use for financial modeling or the traditional rates of, well, 4% or 4.5%. And I think that there's a lot that can be applicable to the clients to say, given the situations, how might we want to or be able to adjust these safe withdrawal rates for their particular purpose and customizing it. So it's been very enlightening.
The presentation was good. It gave us a lot of good data. At Northern Trust, we try to use gold-powered solutions to drive a lot of our investment decisions and try to help our clients make sure that they understand and see that they have the right assets or the right level of withdrawal for the asset level, and that assets do have a purpose, and to understand what that purpose is. So I think understanding this data coupled with how we approach our goals-driven investing is a great background for helping our clients.
The most important piece of information on this subject is that there's various ways to look at it, and that we shouldn't be locked into one model or one group of assumptions, and that it really does need to be customized for the client, and brings forth some methods that we can use to customize it.
So next steps for an advisor that wants to stay up on this is you do need to spend time looking at what the safe withdrawal rate research is beyond just this starting point 4% number. You need to recognize that's something that gets customized and individualized, and look out there at some of the research and tools, certainly what we're presenting here at IMCA about how to do that better and more effectively.